Good morning, good afternoon, good evening, everyone, and welcome to Revenue-Based Financing, Growing While Retaining Maximum Equity. My name is Michelle Eisenberg, and I'm a program assistant at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that is building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. And so as you will see in the chat in a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So definitely check out those links and resources in the chat. And then just going to go through a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. And then secondly, we will open up for live Q&A at the end of the event. So please submit your questions for us in the Q&A function at the bottom of your screen throughout the presentation, and we will try our best to get to them all. Awesome. Virginia, Hawaii, New York, Oklahoma, Florida, all over. That's awesome. Thank you for submitting responses. All right. And of course, none of what we do could be possible at the center without all of the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We are truly humbled by their contributions and hope you're grateful too. And so before we get started, I'm going to launch a quick poll to step back and take a temperature gauge on how everyone's doing today. And we'll use this information to guide the wellness programs that we provide to our community. So this is going to ask, how are you feeling? Fearful, anxious, surviving, or optimistic? Give everyone a couple moments to submit their responses. Thank you. Thank you. All right, I'm going to go ahead and end that poll, share the results. Looks like optimism's in the lead, but we definitely have feelings all across the board. So we're going to try to address those today in our session. All right, I'm going to go ahead and stop sharing. And without any further delay, please join me in giving warmest of welcomes to our special guest, Leah Edwards. She is Investment Director with Lighter Capital. Thank you so much for joining us. I'm going to hand off the stage to you.
Well, it's wonderful to be here. I'm going to share my screen because I have some slides here to use today. And we will start at the beginning. I have been a serial co-founder. I've been an investor. I've been a volunteer with the Nasdaq Entrepreneurial Center helping startups. And about 3.5 months ago, I joined Lighter Capital. And I'm very excited to share what Lighter offers and just to explain the general concept of revenue-based financing with you. And just generally to help you compare different financing options. So we're going to talk about revenue-based financing, but I'm very, very open to your questions. So anytime during the presentation today, feel free to enter questions into the chat. If there are points of clarification on a topic I'm discussing, Michelle's going to interrupt me real time to address your questions. But we will also do Q&A and discussion at the end. And I really encourage you to go ahead and get your questions into the chat, even if you want me to discuss them at the end, just to make sure we have time for your question. And as I was mentioning, I've been an educator around entrepreneurship, primarily at UC Berkeley and Stanford, but also at other universities. After having been a co-founder primarily of software companies, but I've also worked with a lot of smaller businesses doing e-commerce or services, some solopreneurs, particularly some really interesting women that I've met through the Nasdaq Center. And I've been a VC, an angel investor, and now I'm with Lighter. Lighter has been around quite a while. I was sort of embarrassed to not having heard of them until early in 2022 when I met the CEO of Lighter at an investors dinner. And I was just thrilled to discover them. I came home from that dinner and I started emailing companies that I advise or am an angel investor in because I thought it was such a good opportunity. Lighter is a mission-driven organization. We're here to provide an alternative for startups. The concept came from a paper that a professor at Harvard Business School wrote saying there've got to be some other options. And we stepped forward. There's a couple of VCs came together to help us get going. And we're now supported by even more investors and partners. So Lighter's just one option. This is sort of a concept of the different ways that people fund startups or small businesses. Very often in the beginning, you have to just put things on your own credit cards or go to your friends and family for some support. Maybe after you have a little bit of validation, you might get angel investing. Sometimes if you're the kind of business that has equipment, you might be able to get some bank financing with the collateral of the equipment. Or if you have accounts receivable, you might be able to get a bank advanced against those receivables. But generally, you don't get commercial banking and those types of loans until you are a very mature company. And this leaves the question of, well, how do you get to that scale where you can get that affordable money? And so, people go to venture capital, and we're going to talk about why that's a good thing and why sometimes people overuse venture capital to their detriment. Lighter is kind of right there in the middle. We do not provide the initial capital when you're just having a concept, but we really can help companies that have product market fit and have validated the need for their products or services and have validated their go-to-market strategies. And then we can really help them scale. And you. So one of the things that I've talked about a million times in my life, the thing I present on most often is how to raise capital, because it is unfortunately a big distraction in running the core business. And yet it's the most important thing is to not run out of cash. This is the biggest cause of failure of small businesses. And so, most people spend their time chasing after venture capital, and venture capital is highly selective. It's meant for a certain kind of super, super high growth company. And we can talk about this if you care to, but I've given lots of presentations to try to help people understand what is the business model of a venture capital fund and what are their limited partners in their fund expecting of them and why it is that they have to go after unicorns. They have to be looking for a 30% or more internal rate of return. And so this means that very few companies really fit that very, very selective model. So it's not an option for everyone. Banks, though, either require you to give a personal guarantee, they're willing to lend against your house and other assets that you have, or you have to be a very big company that has assets in the business that they can use as collateral. And this is why there's sort of a problem for companies that are trying to scale that don't fit those two models either ever or yet. And so Lighter Capital is really designed to be aligned with your stage where you really, have some financial metrics to show and that really validate that people want what you have and they're willing to pay for it, and that you know how to acquire customers at a somewhat affordable rate. You do not have to be profitable to qualify for our financing. And we don't expect pitch decks. We're very, very speedy in giving feedback about the opportunity.
Hey, Leah, we have a quick question from an audience member. Could you quickly touch on the coverage area of lighter capital, if it's limited to the United States or other parts of the world as well?
Sure. We finance companies based in the United States, Canada, and Australia at this time. Many of our companies that we fund also have operations in other parts of the world, but you do need to bank in one of those three countries and to have significant revenue collections in those three countries.
Awesome, thank you.
So, as I was mentioning, bank debt is nice. I would tell you that generally bank debt is cheaper in the actual apples to apples comparing interest rates to what we can do. The problem is most of startups are just not there yet. They can't qualify for what a bank can do. It's also very, very complicated in terms of getting that banking relationship going, getting the diligence done, whether you're going after venture capital or these bank financings. So we really were created to be founder friendly. We do not require special covenants and guarantees, and I'm going to go over those definitions in a minute. We really try to partner with the companies that we fund. I'm going to explain how revenue-based financing works, where you get to have variable monthly payments on your debt service. But the most important thing to understand is we're here to work with you at your stage. We're very, very fast. We can turn around term sheets in a matter of days. Then the closing might take a couple weeks in terms of the actual legal diligence about your company and setting up the actual wiring of money and all that type of thing. But it's very, very fast. I mean, it is always within a month. So let me get into the definitions, because one of the things about debt is that people often just know to ask about interest rates or repayment terms in terms of, say, number of months or years. But where debt can become very costly to you is in the fine print. So it could be a guarantee, which could be a personal guarantee against your personal assets. It could be a covenant. A covenant might be something that says, well, if your revenue ever drops below X amount per month, then it kicks in that we get some extra warrants, that we get more opportunity to have equity in your company. A covenant might be something that if you become unprofitable as you had been profitable, same thing. We might get double the amount of warrants we had negotiated for. And what warrants are is they're essentially just a stock option. It's the right to purchase the stock at a very affordable price. And this is where a lot of companies get themselves into trouble, is maybe they take venture debt and then something happens to the company where the financial performance degrades for some reason, and then these very high multiples of warrant coverage going to the venture debt offerer or the bank offerer kicks in. And I don't mean to say that these companies are bad. They are not. Banks are not bad. Venture debt providers are not bad. They just have a model where the way they cover themselves for the risk they are taking, loaning money to companies, is that they have the right to get ownership in the business if something starts to happen in those business. It's just part of their business model. It's how they control for risk. And so you really, really need to make sure that you understand any kind of financing that you get into. Always, always, always get advice. I really encourage all startups to have a fractional chief financial officer if you do not have a senior person understanding finance in your company. It is well worth whatever probably just hundreds of dollars a month you would pay for this expert advice on how to choose the appropriate financing at any time and how to understand exactly what could happen. You would probably want to model what would happen if our finances degrade and some of these terms kicked in some of the, financings that we would sign on to. In opposition to all that, lighter capital was designed to be very, very founder friendly. There are no gotchas. We absolutely do not have founder guarantees, covenants, no claiming on your equity at all. The way we control for risk is that we fund a very specific kind of company. And if we fund specific kinds of companies, then we have controlled for our risk. We've been around for 12 years. We have only a 2% default rate because we know who to fund. We have data over all that time. We refine our model of scoring companies for our loans. We price the loans differently according to the risk, and therefore we do well without having to take equity as our risk protection. So, and I do have this one bullet point down here at the bottom. We have very recently started to offer to companies that care to negotiate some warrants for reduced financing cost. They're usually the companies that are on the more developed side of the range of companies we fund. We max out at lending $4 million a year to, or I should say $4 million at any one time. We cannot have any one borrower have more than 4 million outstanding debt to us at any one time. But we also loan as little as $50,000. So we can work with really early stage companies. And these are generally 3-year terms on the financings.
Hey, Leah, we have a couple more questions from the audience. First, how does, if at all, does lighter capital factor in business credit into their funding decisions?
Sure. So if you mean business credit that the company already has some debt, we calculate the amount of debt we feel comfortable with a company having. And if they already have some lines of credit or some other kind of like an SBA loan, we deduct that out. If the question is asking credit worthiness, we have our own proprietary model after this 12 years of experience where we look at your financials and we come up with our internal scoring of the risk. And so we do not use external credit scores. It's our personal evaluation of the financial performance of the company we're looking at.
Awesome. That's a really important distinction. Thank you. And if you could just please explain how warrants work again.
Sure. So often when you are doing, say, venture debt or a private kind of borrowing, then a warrant would be one of the terms. So it would generally be that there's a loan with an interest rate and payment schedule. The warrants are often something that is definitely given, like it's not just something that kicks in if there's something negative that happens to the business. There's usually some amount of warrants that are part of the negotiation. So the company would be saying, we're extending this loan to you. You're going to pay us back at this interest rate with this term, if it's a monthly payment, quarterly payment, or whatever. And also you're going to give us some warrants. So it's the ability to buy stock in your company at a favorable price. They also might have covenants in the agreement that say if certain things happen, then it kicks in that we get more warrants. So we have the opportunity to have more equity in your company. So warrants are options. They're not a they're not saying we definitely are taking equity in your company immediately today situation.
Awesome. Super helpful. Thank you.
So revenue-based financing is structured where you pay a percentage of your cash received revenues every month. And this is a benefit to you as opposed to a fixed principal and interest payment, in that if you either have cyclical revenues or just something happens in any given month where for whatever reason is low revenues, you do not have the fixed obligation. You get to pay lower amounts back towards your repayment of your loan. And so it just works with people managing cash. That's really the main point about revenue-based financing and why it is so aligned to startup growth. Anybody who has experience managing small businesses know cash flow is everything. That you really want to be able to always be able to, one, pay your staff and your fixed costs, but also to be able to take advantage of opportunities, be able to invest in sales and marketing and bring in the new revenue. So revenue-based financing is basically meant to say, we can tell you're a growing business, you can tell you're a growing business. If you could just have your profits from 2 to 3 years out now and invest in the business, you're going to grow way faster. Generally, companies take $1 from us and turn it into $10, turn it into $20. You know, you're looking at companies that have, as I said, product market fit. They know how to go to market. They just don't yet have the cash in the business to keep going at the scale where there is an opportunity. There is demand for their product. They just need to get out there and make people aware, or to be able to have enough staff on board to do the onboarding if that's required, or training if that's required. And so we're just helping them get over the bottleneck where they need the cash now and they need to keep the cash in the business. So they want to have variable payments every month. And so this is really, we're meant to be highly aligned with the goals of the business. We do also offer term loans. Term loan is not used as often. Most people, like I said, they really want to maximize cash staying in the business, but there's just reasons, for certain kinds of businesses where maybe they want a 2-year term loan or something. It means a fixed principal and interest payment, sort of like a fixed mortgage, where you have an amortization table over the term of 1, 2, 3-year loans, where you have a fixed payment. And in Canada, we have to do that. Canada, for some reason, doesn't allow the revenue-based financing, but we can offer fixed term loan financing in Canada.
We just got one more question from the audience. How does Lighter Capital, do you have a preferred debt to loan ratio prior to lending, or if not, how is that navigated?
I'm definitely going to go over what our criteria are. But the basic answer is we do have a scoring of how much we feel a company, it would be good for a company to have, is for the optimal amount of debt to be able to both scale the business, but to not get them into a cash flow crunch at some point. And so if our model said that we think that your company should have a maximum of $500,000 of debt at this time, and you already have $100,000 from some other source, we would say we're willing to loan $400,000 to you. And usually what happens, and I'll cover this later in the presentation, is that the companies we fund tend to grow very, very fast. And they often come back to us before the end of 3 years and say, hey, let's refinance for a bigger amount. And we're very open to doing that. Now, really, I'll cover that in more detail.
Awesome. Thank you.
One of the things I wanted to cover is people ask, how expensive is revenue-based financing? Like, what is the interest rate for it? And, as I mentioned, if you can become a very, very big, super credit-worthy company where a bank is going to loan to you, that kind of debt is, on the face of it, in terms of just interest rate, is looking cheaper. The problem is most companies can't qualify for that. And so we're meant to be this opportunity where you get to keep your operational control by not having to go to venture capital when you don't yet need it, or to the other kind of lenders that could have high levels of warrants and potentially take a very significant amount of your company. I'm going to go over a model in a minute where you can compare the equity cost. But basically, we're here for people that understand that cash flow is everything to scaling their business, and there is almost no capital too expensive. Our cost of capital is coming from, then we have big investment banks that give us big debt facilities that we're able to loan out to you. So we have the amount of money we have to pay to them, plus all the costs of giving out what are, in the way the financial markets would consider it, these are really, really tiny loans. So as high operational costs relative to the size of loans that we're giving up. Because of the way revenue-based financing works, there isn't an explicit interest rate until you look into arrears. So as I was pointing out, the amount you pay per month is going up and down based on your revenues. So we can give you the range when we give you a term sheet saying, we're expecting that you're going to, over the course of the loan, have paid this much annualized interest. But you can only in any given year look back to the year and say, how much did we actually pay off versus the total amount financed to get the exact interest rate. It's a little bit of a fine-tuning point, but just for you to understand. But what I really want to explain to you is, why have hundreds and hundreds of startups thought that this kind of a loan, which costs between 15 and can go into the 20%, why do they consider this cheap and amazing money? And this is why. If you go to venture capital firms and say you only sold off 23% of your money, which is a very modest amount, most companies, when they get to an exit, if they've gone to venture financing, the founding team ends up owning 10% or less of the business. And so when you hear about these big, this company was sold for 300 million, or this one was sold for $1 billion, the founding teams usually own a tiny, tiny fraction of the company. So if you were able even to just have given up 23% of your company, and say you sold it for 120 million, you got your company to a $24 million of annual revenue, you sold the company for 120 million. If you've given up 23% of your company and you've given away 25 million of the valuation. Now, if you need to, you need to. Venture capital is not bad. Venture capital is meant for a certain kind of company that is very high risk. Maybe there's high capital costs to get your company going, or maybe you need a high level of financing at the very beginning before you have the revenue validation that lenders would need. If you have to go to venture capital, it is amazing. The problem just is that too many startups get themselves into this habit of, okay, I raised one round, now I need some more capital. I'll go raise another round. Now I need some more capital. And you just let your ownership get whittled away. If you have product market fit, and if you can prove that you know how to go to market and you know how to bring in the customers, and you're moving towards profitability, don't even have to be profitable, you might be able to qualify for revenue-based financing and be able to keep a very significant amount of your company. Now, not financing with venture capital if you really need to, or with angels or everything, is not necessarily the answer. That's this middle bar. What if you went really slow? You didn't take in any financing at all. And by the time you're able to sell your company, you've only made it to $5 million revenue instead of in the bar above. I was saying, what if you got to 24 million annual revenue? If you only get your company to 5 million revenue and you're selling at the same multiple of 5 times your revenue, you only have an exit valuation of $20 million. So it's not necessarily the answer to say, I'm not going to give away any of my company to anyone. That's not necessarily the ideal answer. And as I said, we were founded to try to find some middle ground. If you can use some debt financing and say you still get your company to a different, like maybe because you didn't have a prestigious venture capital on your firm, on your cap table or whatever, maybe you only make it to 20 million in revenue. It can still be amazing if you have 100% and you get to $100 million valuation. It's a way, it's better to have more of your company. You might still have gotten to the exact same revenue amount. You might still get to the 24 million revenue just using pure debt financing, in which case exit valuation 120 million is all yours. So when you think of the cost of financing, you have to think about what all the costs are. And equity has a very high level of cost. I mean, for one thing, I can promise you that every venture capital firm is hoping for at least a 30% internal rate of return. They're really looking to own a percentage of a company enough so that when that company one day is sold or IPOs, that their portfolio would have this 30% internal rate of return. So think about that when you want to use venture capital. And one of the things that debt financing can do is it can help you get to a level where a venture capital firm might give you a very, very good valuation, in which case the cost to you is lower. When they ask for a certain percentage of the company, they're either going to give you a lot more money for that percentage, or if they're willing to put in a fixed dollar amount into your company, they're going to get a much smaller percent of ownership for your company if you have really scaled and have a very strong financial position at the point you're in that funding round with them. So there's a proper stage, there's a reason for different financing. You need all the kinds of equity financing, the friends and family, the angel investors, the accelerator programs that give you some cash, SBA loans, what VCs can do. You need those kinds of money when you're still validating the need, when you're still finding product market fit or still figuring out your pricing model. It could be that you've been operating for a while, but now you're doing some kind of major pivot and you're maybe trying to build a new product. Those are all times where you're sort of telling the story about the future of your business that you will need an equity investor. When you are just trying to fund growth, when you are saying we have very good financials to show you, it's just we're way smaller than we know the market opportunity is, that's when you go to lenders who help you fix your cash flow problem. They help you get the money now to invest in the business that you can bring in. Use of funding of revenue-based financing is most often just to fuel company growth, to really to invest in sales and marketing, maybe bring on a couple more engineers to really beef up the product and have additional revenues from upsells to existing customers, or to go into a new market segment where if you had a slightly modified product would be more attracted to a larger market. But we do sometimes get asked to help bridge between funding rounds to smooth out cash flows. There's just a lot of of reasons that people want to have extra cash in the business. I'm going to give a couple of examples here, and then we're going to pretty quickly go into the main discussion of Q&A. So really be thinking of your questions, maybe start entering some of them into the chat so that we can make sure to cover what is helpful to you. But I want to give you a few examples. So one of our clients is called Full Circle Insights. They did 3 rounds of funding with us. This was, helping them go between their seed and their Series A. They didn't want to go out for the Series A until they had really achieved a certain amount of revenue, had really improved their metrics so that they could be, really getting a good offer from a VC firm in their Series A. Another company called Map Anything, they did 5 rounds of funding with us in order to get into a good position. They were able to raise then venture capital from, very big name VCs, and they were eventually acquired for $200 million. And they got to that scale within just 2 years. 5 rounds of funding accumulating only to 1.65 million meant that they were a pretty small company when they first came to us. None of these loans were over 6 figures. And so, they really used the money to boost their revenues and their traction. Here's another example of a company that was a little bit further along when we first financed them. They received $2 million in just 2 rounds of financing, but we helped them go from 4 million to 20 million by having that cash to put into expansion of the business. And eventually they were able to, when they went out for a raise, their very first equity raise was at over $1 billion. And so that means the founding team of that company, everybody's worth hundreds of millions. And so this is the kind of situation we love to support. We work with people that are entirely bootstrapped. We work with people that have already had some VC, had some seed money coming in. And what we look for is very predictable revenue streams. It can be recurring. It doesn't have to be a monthly or an annual subscription, but that is one way to have highly predictable revenues. We look at the history of growth. It makes us nervous if there's a little bit of an economic downturn like we're going through now, and then the revenues decline. We're looking for payback. We're only getting our money paid back to us if your revenue stays up. Another thing for that same reason that we look for is very high gross margins. If you have more than 50% gross margin, you're much more likely to be able to both do our debt service, which is just going to be a small percentage of your monthly revenue, but still have money in the business to go grow it. So we're looking for, revenues that we can count on, high margins. We are very quick. We really provide quick answers. And lots of companies, though, if they take a 3-year financing with us, have grown so much, 18 months into the business, 24 months, that they actually come in and say, hey, let's refinance for a larger amount. It's very, very common to do 3 rounds of financing for us. But, we have a company here who's done 9 rounds of financing with us because they just grow so much and they just want to come back for more. We really partner for the long term. I just want to say we have a big community effort. We have a Slack group for the people that we fund. We do monthly CEO calls where we pair you with people in your stage where you really can meet other people going through issues that you're going through, get peer advice. We have an annual summit. This year it's going to be in October in Austin, where we bring the founders together that we're funding. We have hundreds of thousands of dollars of discounts to other software, including $25,000 of AWS credits. We make introductions to VCs. we're really here to support the companies for the long term that we work with, and just don't want to run out of time. So I'm going to stop my slides so that we can make sure to get to the Q&A of people attending today. So.
Awesome. Thank you so much. So many practical tips. That was just so awesome. Before we launch into the Q&A, I'm just going to launch one more quick poll. It's going to ask, what's keeping you up at night? Give you all a few moments to submit some responses. Awesome. Thank you so much. I'm going to go ahead and end the poll, share the results. Finance is in the lead, definitely have sales, marketing, and scale on the mind as well. So we'll keep that in mind for future programming. All right, let's jump into Q&A. So I'm thinking we do kind of like a rapid fire. We have first a ton of questions, just specifics about how Lighter Capital works. First, what is your DSCR for the term loan, and is officers' comp included in the equation?
So I have to admit, I don't know what DSCR is. So if someone would put that in the chat, I will answer. And yes, we do look at all expenses in the company in terms of our financing. Oh, debt service coverage ratio. Well, thank you very much. I appreciate that. So we definitely include that. We don't have an explicit number. We have our proprietary algorithm. So we look generally to lend companies 4 times their monthly revenue. That's the most common size. It can be anywhere between 3 and 6 times the monthly revenue. And as I was mentioning, if you've already got some debt, we're going to back that out of what we think would be a comfortable amount based on our experience, where companies don't get themselves in trouble. So, but 4 times revenue, you can just use as a back of the envelope.
Awesome. And so you touched a little bit on this, but how does Lighter Capital deal with the higher risk of not being paid back by these small businesses? Like, does it work in a way that like the business doesn't get all of the money at once?
Nope. We give you all the money right up front. So basically it's like a fee. So for example, I extended a term sheet to somebody recently that was $1 million, and the flat fee was $380,000. So it said, we're giving you $1 million the day the loan closes, we wire you the money, and then within 36 months, we will have collected the $1,380,000 back. And it's a percentage of monthly revenues. And we have just the experience where we say, this is the amount you're going to pay of your monthly revenues back. The way we control for risk is just with our experience. We fund companies with predictable revenues with high margins. We do the financial analysis to price the loans. Like that 1.38 wouldn't go out to anybody. This was a very, very creditworthy company. We're offering unique term sheets to each company where we are using our own experience to say, this is how we price that risk. But we also do not subordinate to other lenders. So say something should happen to a company, which almost never, we've had, like I said, less than 2% default rate. We are first in line. Debt holders are ahead of equity holders, and we do not subordinate. I mean, maybe if you have a bank loan from an FDIC insured bank, a real traditional bricks and mortar bank, we might subordinate to that, but we generally do not subordinate. So this is another risk control.
Awesome. And so kind of in those rare instances of default, how does Lighter Capital protect itself when, the startup doesn't have those kinds of outcomes that you're looking for?
Well, this is, one, you want to be first in line in this kind of situation. But second of all, this is about those 3 countries that we are able to lend in at this time. You have to really be very sure about the rule of law in the countries you operate in and what your, what would happen if you need to go to court, that kind of thing. So fortunately, this almost never happens, but you definitely want to have the court supporting you with the contracts that you have.
Awesome. Love it. All right, let's see what else we have here. Is revenue-based financing offered in a line of credit form, meaning that the business pays interest only on what they've drawn?
We do not offer lines of credit, but we do offer term loans, and sometimes people negotiate for, interest only for a certain number of months on the term loan.
Mm-hmm. Awesome. And then let's see, how is the monthly payment calculated? Or so like if there is a monthly payment?
So there always is a monthly payment. And for a revenue-based financing, it's part of the term sheet we offer. So it's part of us pricing it into the loan. We say, here's the offer of this amount of money, and you'll pay back this percentage of your cash received revenue per month. And so it's different for every company.
Awesome. And then I think you may have touched on this earlier, but if you could just one more time, is there a minimum revenue requirement?
Well, generally you have to have at least $15,000 of monthly revenue. When we look to lend, like I was saying, on average, it's a 4 times monthly revenue. We're looking at your 3 to 6 month average of your revenue. And if you have not been in operations for 12 full months and have revenue history of 6 months, that shows you're up to an average of 15K. You just don't have enough history for us to run through our model. So we need you to get this is where you really do at that time need some friends and family money, possibly your own money to get off the ground. We're not, unfortunately, that's not what we do. We really help people scale, but you can be pretty early on to only have an average of 15K revenue, and we can help you scale from there.
Perfect. Love it. And then, so somebody was asking a little bit, switching gears, how would you be able to share some practical tips for how different types of companies might approach best practices when it comes to revenue-based financing? So for example, like if there's a difference in like the way tech companies versus product-based companies might address, like navigate revenue-based financing. And if you could also touch on maybe sole proprietorship.
So we don't have a minimum number of employees that you need to have. I mean, you could be a sole proprietor if you've got predictable revenue and good margins on what you're doing. We don't have a bias or, against the size. Since we need 50% gross margin, it's a little bit hard for companies that are too based on product sales, hardware sales, and things. Now, software generally has, software as a service generally has in the 90%. So you could have a blend of hardware, software kind of business. But if you're highly service oriented, where you have a lot of labor costs to serve a certain customer contract, then you're probably going to drop your revenue. So we're very focused on the metrics. How you get there, we don't have a bias against them if you meet that metric.
Perfect. Love it. And so how does Lighter Capital adjust their model when an economic downturn occurs?
Well, I do have to say we work better with companies that are B2B, and B2C tends to be where there's a little bit more of immediate reaction to financial downturn. So we're not explicitly 100% against B2C companies, but we definitely look for predictable revenues. And we do see much stickier revenues in terms of the monthly renewals, annual renewals to the B2B, more tech-enabled businesses. So that is why we fund those much more often. They get better credit scores. And in general, right now, we actually have had extraordinarily high demand for our kind of financing right now. The VCs have really pulled back. The VCs are watching and waiting. They're not as active. There's not, it's taking a long time for the people that do get venture capital term sheets generally. And some of them are just not some companies are just either not able to get any, or they're not able to get a good valuation. So right now, a financial downturn is really boosting us. We have a lot of people coming to us saying, wow, we so don't want to go out and do an equity raise right now. We really want to scale for a year and hope that the venture capital market conditions improve if they intend to go to venture ever. The financial downturn is actually fine for us.
Okay, awesome. And so we have a couple just questions clarifying about whether there are any types of industries that lighter capital doesn't generally work with, like maybe beyond just like a general product-based model.
Well, I recently had a company want funding from us that they weren't selling cannabis, but they were in the cannabis industry. And we have banks as our investors, truly federally funded, federally registered banks. So that we couldn't do because just what the risk could be for our total ecosystem. So that was a little surprise for me, because they weren't actually selling cannabis, but I had to learn a little bit the hard way that doesn't work for us. So there really isn't, I think we would not do anything really related to crypto right now, but we don't read pitch decks. We look at the financials of every single company. So we end up with quite a diverse range of companies that we fund. It's up to their customers. Their customers are saying, we want this, we're buying it. Someone asked in the chat, like, do you have to be profitable? No, you don't have to be profitable. You have to be showing that people want what you have. And so we are neutral about what it is you're doing. If you have a market and you know how to go acquire those customers and keep them happy and they're renewing, that's all great.
Love it. Awesome. And then we just have a couple more quick questions about the way lighter capital works. Is there any penalty for paying off earlier than 36 months?
Very, very good question. So of course, we need to make money. We're a mission-driven business, but we're a business. So if you were, say, to take a 36-month financing and want to pay off in less than 6 months, there would be a fee to be able to pay off. You could, but you would pay us a fee because we need to make our money off of all the effort that we're going to. Same thing if it was 12 months or less. If you had just a regular financing and you wanted to pay off in 24 months, I think there's no fee for that. What happens most often, remember I was showing all these companies that have financed with us 9, 5, 4, that chart.
Right.
What happens most often is companies come to us, they have a 36-month term, they're growing so fast, they know they qualify for more money from us. They're coming to us and saying, let's refinance for a bigger amount. And of course, we charge absolutely no fee for that. We would rather give a bigger loan. So no fees for refinancing, minimal fees for getting out early, really, really, really early. I do want to say also, we have no underwriting fees. There's no fee whatsoever. It's just that sort of fee for the whole loan is the only thing. If you're applying with us and you've accepted our term sheet, we do have some third-party legal fees that are capped. I mean, and they might be capped at 1,000, or they might be capped at 3,500 if it's a much bigger loan or something, but they're capped, and known, and you don't have to pay those until a couple months into the loan itself, so that we're not taking cash. We give you cash and then we're taking cash right away, back out. We want you to grow the business.
Perfect. Love it. And then
So can we answer about the government, just because I see that in the chat?
Absolutely.
No exclusion to selling to the government. As a matter of fact, sometimes government contracts are the most sticky. So we are not judging where, who your customers are. We have a little bit of a geographic issue around like if you're selling a lot outside of the US, Canada, or Australia, if say 80% of your revenues were outside of those 3 countries, we might have a problem, because we're depending upon your revenues coming into your banks in one of those 3 countries, and that's how we get paid. So geography could be the only issue.
Awesome. And then we just have time for one more key takeaway. If there's something that you would want the audience to take away from this whole session, what would that be?
Well, one is know your options. You're really, really welcome to reach out to me at any time to talk about your options. And I've been a VC. I love VC. I founded companies supported by VCs. Those companies never would have gotten off the ground without angels or VCs. There is no bad financing. It's just you might make the bad choice for your company. And I was so excited to find out about revenue-based financing when I did, because I so wish I had kept more equity in the companies that I co-founded. And if I had had this as an option, I would have diluted myself so much less, and it would have made a real difference in the exits.
Awesome. I love it. So many important things for us to think about. Thank you so much for taking the time to speak to our community and share your insights. On behalf of the Nasdaq Entrepreneurial Center and everyone in attendance today, we sincerely thank you for joining us. And to our audience, we would love for you to join us for upcoming webinars. You can view the upcoming events by using the link that's going to be posted in the chat. And thank you all so much for joining us today. We look forward to welcoming you back online with us soon.